Hello and welcome. Today we will be telling you briefly about Reddy Ice Holding Company. I am joined by my fellow Birkenrose research analysts, Jean Capella, Amy Domingue, Vikram Gulati, Udi Rosenhan, and my name is Michael Wolfen. The company was founded in 1927. Reddy Ice is the largest ice manufacturing and distributing company in the U.S., operating out of Dallas, Texas. The company has been publicly traded since 2005 under the New York Stock Exchange ticker FRZ. Reddy Ice distributes to channels such as supermarkets, convenience stores, club and mass merchandisers, drug stores, and construction sites, and have recently looked for expansion into the non-commercial sector. As did many companies during the credit crisis seen in 2008, the stock took a major hit. On February 29, 2008, the price was $23.57 a share. Only a week later, though, on March 7th, the stock was trading at $15.38 a share. Looking at 2008's numbers, the stock hit a low of 55 cents a share. Over the past 3 months, the stock dropped from $1.87 a share to 59 cents a share. This sell-off occurred very close to the release of poor third-quarter numbers in early November. Due to several large negative price drivers, we've arrived at a price target and market underperform rating at 57 cents a share. And now we will go through some of the key points to know, which will give you a better understanding of how we arrived at this price target. Now to touch upon some key points about Reddy Ice. Reddy Ice faces very large debt obligations, with around $450 million in debt. That's interest payments around $15 million a quarter compared to operating income in good quarters of around $20 million, and in bad quarters, this number is negative. As you can see, as indicated by the NAs, since Reddy Ice has around $450 million in a positive equity scenario, they are comparable to Manitowoc in the 400% range. The company has recently faced not one, but two delisting warnings from the New York Stock Exchange. One for having a market cap of under $30 million, and two for trading under the minimum $1 share price requirement, as they're currently trading at 59 cents a share. Reddy Ice functions with large economies of scale and scope, satisfying demand of a very large customer base around the Sun Belt region of the United States. The company's unique scale allows it to serve major segments of large customers like Walmart and Exxon. When we visited management, we asked about the company's large Walmart exposure. We were told that because Reddy Ice offers a large regional presence and the ability to automate the administrative functions like payments and delivery schedules, the company is able to keep Walmart as a customer. Few other ice companies can offer this scale. Also, the company's cash flows are very closely tied to weather trends. Don't forget, with ice as its only product, sales are always better in warmer times. Quarter 2 and 3 revenues usually account for over 70% of Reddy Ice's annual revenues. This stock is out of favor, but given their dominance in the industry and previously high margins, the company represents a unique opportunity for any investor with an extremely high tolerance for risk. Now to touch on the positives. Reddy Ice has seen improving margins over the last 2 years. This can be attributed to the increases in its operational efficiencies. As of last year's 10K, 60% of Reddy Ice's facilities had been automated, with machinery to fill and stack the ice bags in many of its factories. Reddy Ice had antitrust litigation, which is now winding down, as well, with economic conditions improving and many positive numbers coming out daily about U.S. growth and growing optimism out of Europe. This may be reflected in the sales of Reddy Ice next quarter. Now, to touch upon some of the negative drivers. As we mentioned earlier, some of these negatives include Reddy Ice's large amount of debt, with $450 million coming due in 2014. The company's trailing 12-month interest coverage ratio is 0.13, meaning it can currently only cover around 13% of its outstanding interest. Also to stress again, Reddy Ice also faces multiple threats of delisting due to its inability to satisfy two major listing requirements. This poses a threat because if Reddy Ice was delisted, investors' shares would be much less liquid. And now we will go through our industry analysis, starting with a brief overview. The ice manufacturing industry is very fragmented. There are no major national players either. Reddy Ice's main two competitors only represent small amounts of Reddy Ice's scope. Here you see that Home City's revenues are only about 30% of what Reddy Ice's revenues are, and Arctic Glacier's revenues are only about 60% of what Reddy Ice's revenues are. The main industry cost drivers are the cost of fuel for delivery trucks, resin prices for plastic bags, electricity for manufacturing, and labor costs. And now we will look at Porter's 5 forces analysis. Barriers to entry are low because new companies do not need large amounts of startup capital. Brand loyalty is also very minimal, and customers' switching costs are low. However, there are high costs to compete at Reddy Ice's level of economies of scale. The main suppliers do not maintain bargaining power. The main determinants, commodities prices and market risks, are exogenous factors that suppliers do not control. Buyers maintain bargaining power because brand loyalty is low and there are little to no switching costs between brands because customers will buy ice at the most convenient location regardless of the price. Competition in the packaged ice industry is relatively high with lots of small local operations with revenues under $2 million. Which makes sense if you think about it. Many stores will oftentimes manufacture and sell its own packaged ice in order to meet local demand. As a result, Reddy Ice lacks publicly traded peers. The one exception is Arctic Glacier, who is currently facing financial trouble. In these competitive environments, these rivals end up competing on price and delivery logistics in order to maintain a competitive advantage. To keep this competitive advantage, Reddy Ice has developed the following strategy. With a previously aggressive acquisition strategy, this has now been slowed due to its tax situation and outstanding debt obligations. In addition to improving DSD and ISB, they are looking to expand to non-retail clients, such as airlines, hotels, and construction companies. Reddy Ice is also looking to further penetrate the billion-dollar ice machine subscription market. They've taken steps to do this by holding an equity stake in a company called Easy Ice. These ice machines can be seen in hotels, food courts, and in the backs of stores and in places like restaurants. These factors played an important role in the assumptions we made to arrive at our price target. We assumed that Reddy Ice will be temporarily halting its acquisitions and in the short term be able to pay its interest expenses. In the long term, we assume that Reddy Ice will be able to refinance in 2014. To arrive at our price target, the valuation we used was a discounted cash flow model. We projected this out twice with time spans of 7 and 9 years. We did this using terminal growth rates between 0.2% and 1%. As there are no true peers in the industry, we were unable to use a comparables or multiples analysis and relied solely on our DCF. To conclude, we will be giving Reddy Ice a market underperform rating with a price target of 57 cents a share. Here's some things we will be looking for in order to see a stock rebound. These things include an improved EBITDA, reduced operating costs, and new injections of capital. Thank you very much for your time and for listening. The Bergen Road Reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thank you.